The push-pull between the bulls and bears as U.S. markets sit at near record highs. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. And of course, with the indexes near record highs, it's just a matter of getting
going to get there?
Yeah,
Are we gonna get there, Scarlett?
Not quite, not quite. Let's take a look. You have the NASDAQ 100. That is at a record high, just barely, but any gain at this point is a new high. We're looking at lower two-year yields. It's actually down for a sixth straight day as shorter-dated treasuries continue to outperform the longer end. Jay Powell, the Fed chair, did speak again today. Didn't say anything to change traders' bets for 1 to 2 rate cuts later this year. Oil prices halting 2 days of losses, now up 1.33%. And the Bloomberg Dollar Index marginally lower. Really, the dollar's not doing a whole lot, but the index is right around a 3-year low, Romaine.
All right, let's go back to the S&P. The S&P at 60.88 and change right now. We actually did have our first open above 6,100 earlier in the day, the first open above 6,100 since February, and that really does have the S&P within reach of this all-time high. But based on the price action today, it is a long reach. Market valuation metrics are exceptionally high, and the roll of the dice right now for the bulls is a bet that corporate earnings will indeed catch up and outweigh any drag from geopolitics.
Look, it's all about earnings in this case, right? Earnings have been good, have been better than expected in Q1. We're coming up on earnings season going forward. And as long as earnings are okay, the market can ignore a lot of the bad news.
That's part of the bull case. For the bears, they'll point to the fact that even with the NASDAQ 100 and S&P round tripping back to or above those February 19th highs, at least half of the individual stocks in those indexes are still in the red over that stretch. That includes names like Qualcomm, Adobe, Airbnb, Lululemon, and Northrop. But let's go back to the bull case, because it is decidedly structural. The idea that major changes in the economy and technology render historic valuation multiples moot. Case in point, Loop Capital today projecting a 65% jump in NVIDIA's valuation to $6 trillion amid a golden wave of Gen AI adoption. And for investors looking for new ways to bet on that sector, they've also been piling into an old tech name, Micron, the maker of memory chips, on a 12-week, 96% run, and it reports earnings, Scarlett, after the market close.
Yeah, but of course, that's the tech sector. We have to look beyond the tech sector overall. So I want to go back to the valuation metrics. This is a big reason why the S&P 500 is stuck in a range, albeit at the upper end of a range that puts it within striking distance of a new high. After rebounding from the April sell-off, the index is currently trading at about 22 times forward earnings. That is the white line here. That forward PE is about 35% above its long-term average. That's this horizontal trend line here. This is against a backdrop of major headwinds like the end of Trump's pause on tariffs, conflict in the Middle East, setting a very high bar for companies, not just those in tech tied to AI, to top expectations when earnings season rolls around in about 3 weeks' time, Romaine.
Absolutely, and we should always point out quite a few investors are sitting on the sidelines, particularly when you take a look at what's happening in short-term debt markets. Alex Petrone joins us right now to kick us off to the close, head of fixed income at Rockefeller Asset Management. Alex, great to see you.
Wonderful to see you. Thank you.
Let's start off with the fixed income space and the shortest of the short end of that fixed income space, money markets. $7 trillion plus dollars. That hasn't really budged. Everyone was expecting that to come down after we had those big rallies over the last few months. When, if at all, does that money come off the sidelines?
We're already starting to see that. We're seeing investors that have started to push out over the course of the last, call it 12 to 18 months, because when you look at fixed income markets, when you look at the path that was expected for the Fed, it made natural sense to step out, lock in income, lock in yield, right? We had an inverted curve that re-steepened for some time. Investors started to step out. That said, uncertainty still abounds, right? We started the show with that. We see it every day. And so I think investors are really looking for, can I get past some of the headline risk that we see to push out the curve? That's happening and it's underway. That said, we've had tremendous headline risk. April trade wars, of course, Moody's downgrading U.S. debt. Of course, you forgot about that because we've had other things since then, re-steeping of the curve on the big, beautiful bill. So I think it's investors getting comfortable with where should I allocate the next marginal dollar.
So for those folks who are looking to the fixed income market as a signal of maybe a broader risk appetite, where is that signal going to come from? Are we going to see that more from the Treasury market, or are we going to see that more in the corporate space, and maybe the willingness of people not only to extend duration, but maybe even go down the ladder in credit quality?
Well, I think historically we've always looked to corporate credit spreads as an indicator of risk tolerance in the markets, and corporate credit spreads are quite tight. We saw some widening through Liberation Day, and that, of course, has come back in. That's a signal that we have that risk on tone, similar to what we see in the equity markets. Treasury market volatility persists, and that's really, I think, some discomfort depending on the spot of the yield curve. When we think about the long end of the curve, really influenced by the expectation, I think, of future deficits and where rates should be.
Yeah, then that raises all kinds of existential questions that are kind of unanswerable right now. The belly of the curve, though, has been well received, and we're seeing auctions reflect that. The 2-year auction did pretty well. 5-year today, not as well. When do we get out of this phase where we monitor every auction like it tells us the fate of treasuries?
Scarlett, I look forward to that day. I think we all do. And I think we're heading towards it. You have an FOMC that we know is starting to diverge in their opinions. We've seen a little bit of a lesser reaction to every auction versus what we experienced in 2022 and 2023. I think the reality is we're heading towards a period, yes, uncertainty abounds, but we're probably going to head towards a bit more rate stability from here. Of course, we expect that the yield term premium will continue to reside, and it really just becomes a question of demand re-entering into the market. Of course, we saw some things today coming from the Fed in terms of capital ratio requirements for the banks that can help to lend to some added treasury stability. But I think what we really want to focus on and what investors ask us is, if I care about the long term, should I focus on those individual data points, or should I think about how the economy is going to evolve over the course of the next 12, 24 months from here? And then from that, do we think that fixed income valuations yield income for a level of risk? Are they attractive today? We would say resoundingly yes.
Yeah, but those are questions that, get revisited often because of changing policy. I'm glad you bring up the SLR, the supplementary leverage ratio that Jay Powell discussed in his hearings yesterday and today. How much of that is priced in, this increased demand from banks?
I think probably not enough yet, because you have the pros and cons here and an expectation that we're heading in this direction of deregulation. But until we actually get through the period and get approvals, it likely has yet to really bleed into the market and can lend to some stability, especially in those periods where volatility is most elevated. The banks can and should become a provider of liquidity, exactly what the Fed should want to see.
Is there a willingness to do that? I know the banks, or at least some bank CEOs, like to complain about how hamstrung they are, but there are other banks that clearly have had the flexibility to do that and have chosen not to. Sure. And we've seen that market, to a certain extent, certain parts of that market ceded to private capital.
I think that willingness will remain to be seen, right? It will remain to be seen, and willingness often then ties to valuations and opportunity set, and in periods of elevated volatility, remains to be seen, but we'll watch it closely.
All right, Alex, always great to have you.
Beautiful, thank
Alex Petrone, head of fixed income at Rockefeller Asset Management, kicking us off to the close here on this Wednesday afternoon. When we come back, a conversation with the world's largest meat producer. A look at U.S. cattle supply at a 74-year low, and beef prices hitting record highs just last month. We're going to sit down with the CFO of JBS when we come back after the break. This is The Close on Bloomberg.
Brazilian meat giant JBS ringing the opening bell at the New York Stock Exchange today following its U.S. listing last week. That long-awaited green light from regulators marks a crucial step for the world's biggest beef, poultry, and pork producer. Those U.S. shares trade under the ticker JBS and are down almost 3% from their debut. Joining us now live from the NYSE is JBS Global's CFO, Guilherme Cavalcanti. Good to speak with you, sir. Congratulations on the listing. Tell us why it makes sense for the company, for JBS, to list in the U.S., specifically the financial flexibility and access that this move offers that you wouldn't otherwise have.
Yes, for us, again, we are very happy to be here, to have this listing done. Now we have access to a much broader investor base, U.S. investors, so we are very happy. And this for sure will give more flexibility and most likely decrease our cost of capital.
So one of your goals is inclusion in stock benchmarks like the S&P 500. Model out for us what that means in terms of widening your investor base. You talk about access to U.S. investors. What do you anticipate your investor base to look like in 2 years' time and 5 years' time?
Yeah, that's a good question. Since we announced the milestones that we reached this semester, our foreign investors, from a percentage of our free float, came from 65 to more than 80% already. Our U.S. investors already grew this year more than 20%. So I think that's the first effect from the listing. And given that, according to Morningstar research, 54% of all assets under management now are passive funds, the inclusion in the indexes is something that makes a lot of difference in terms of demand for stocks. And given that more than 50% of our sales are here in the U.S., you can be eligible as a U.S. company and start applying for those indexes. I think probably Russell index will be sooner. And then, of course, there's several other indexes that we will be working to get in. And, of course, our ultimate goal is to be on S&P 500. It takes a little more time, given that we need 6 months to 1 year listed here in the U.S. before I start applying to the Dow Jones indexes.
Absolutely. And a big part of that, Guilherme, is going to be this idea of what the trajectory of the company is with regards to revenue and profitability. I am curious about the investments that you have already made here in the United States, and more importantly, some of the investments that you plan to make in the United States. What's on tap right now?
We already announced several investments, like $200 million in beef company. We announced pork facilities. Also, our Pilgrim's Pride, our chicken company, made their investor day in NASDAQ and also announced several projects of growth. So basically, we keep growing, and with the organic growth is part of our strategic plan. In the last 5 years, since 2019, we invested around $4.5 billion in growth capital expenditures, and we continue to, as this year, for example, we invest more or less $1 billion in growth capex, and in all regions of the world. But given that U.S. is our biggest operation, tends to be our main investment, but also Brazil and other Europe, so on and so forth.
So obviously with this listing here in the United States, it's going to bring a lot more scrutiny to the company, and it took you a while to get that listing because of some of the concerns about your market dominance. Just yesterday, we heard from Republican Senator Josh Hawley calling out what he says, in his words, are monopolists in the meat industry. He specifically singled out Tyson, but as you know, they've also in the past singled out JBS. How do you address this issue of your market dominance and square that with the desire by a lot of folks in Congress to bring prices down for meat, and more importantly, to ensure more diversity in options?
I think going forward, we have a relevant position in beef, pork, and chicken. So going forward, our growth will be on the prepared food segment, which is a much more pulverized sector. So that's where we desire to be, where we're going to downstream our production to get closer to the customer, be more on value added and on prepared food segments.
So this U.S. listing is a huge victory for the two brothers who control JBS. We know they've spent decades building up the company, buying rivals, but along the way, they've also admitted to bribing politicians as well. What kind of guardrails has JBS put up to prevent this from happening again?
We invested a lot in very robust compliance programs throughout this year. So I think we are very confident that all the programs, the compliance programs that we put in place all over the world will prevent from anything like this.
Guilherme, really appreciate you taking time for us here. That's JBS Global Chief Financial Officer Guilherme Cavalcanti, live from the NYSE. When we come back, we're going to focus in on some of the individual movers with a big rally today in chip stocks. But Micron sitting out of this one. The shares have been on fire, up about 96% since some of those April lows. That company reports earnings after the bell tonight. We're going to give you a preview when we come back after the break. This is The Close on Bloomberg. All right, time now for our top calls. The big movers on the back of analyst recommendations. And we start off today with Yum Brands. The operator of Taco Bell, KFC, Pizza Hut upgraded to overweight at JP Morgan on sustained sales growth and the prospect for strong free cash flow. The analysts also applauding the pending promotion of CFO Chris Turner to the CEO chair a little bit later in the year. Those shares right now on a 4-day run, up 3% on the day. Next up, Coinbase, Bernstein raising its price target to a street high $510 from $310, as the company should benefit from legislation on stablecoins and crypto. The analysts calling Coinbase the most misunderstood company in their coverage in the crypto universe. We should point out at one point on the day, Coinbase did trade above its record high, up about 2% on the day. And last up, Stellantis, Jefferies upgrading to buy. The analysts noting the automaker's operations may be starting to make a positive turn and that many of the company's issues are, quote, self-inflicted but fixable. Those shares up 3% on the day, and those are some of our top calls. All right, we are keeping an eye on the tech space and specifically Micron. The share is slightly lower on the day as the chip maker prepares to release third quarter results in just about an hour's time. Joining us for a preview of what to expect is Pierre, Ferragu, managing partner over at New Street Research. All right, Pierre, we talk about the growth in Micron, and obviously it's kind of been a stealth grower in this sort of AI boom. What exactly is the issue here that sort of takes this stock even further? When we talk about these high bandwidth memory chips, what is that, or how does that fit, into the broader AI infrastructure ecosystem?
Yeah, thanks, Romain. It's a very good way to frame it. So HBM, high bandwidth memory, is the fastest growing COGS of AI. So when you look at the content of these super chips and these giant data centers, the fastest growing part of it is HBM. It's relatively well understood. And so what the street is really expecting for Micron and peers like Hynix and Samsung is that HBM is growing very fast, but it's still a very small part of the market today. And as HBM is growing into the mix, it of course grows the overall top line of these players, and it's improving margins. Because HBM being in very short supply and very high demand are much higher margin, think 60%, versus the rest of the DRAM market that would be more like at 40% margin. These are the things that are well understood by the street.
So when we talk about the ability to sort of grow beyond just the whatever normal AI hype we might be in right now, is there sort of a long-term growth story there that investors can hang their hat on? Because I know these growth levels aren't going to sustain themselves, but they could come down to a baseline that is still going to be above historical averages or not.
Yes, and most importantly, Romain, what you have to remember is that memory is all a game of selling more than you can produce. That's how you make money in memory. And so if investors understand relatively well today there's a very high growth in high bandwidth memory in HBM, what is less understood is that as the memory fabs are being repurposed to produce more HBM, it's actually shrinking the supply available for traditional DRAM, for DDR5, for the DRAM for your smartphone and your laptop. And I think what you're going to see that is very unique to memory and that is less anticipated by the street and probably a source of a positive surprise tonight is that the margin of traditional DRAM is going to increase and going to be guided up because the growth in HBM is not only good for memory because it's a growing business, but also it's shrinking the supply available for other products.
That's really interesting. So how much more will that limited supply of DRAM and the legacy chips contribute to margin expansion overall?
So when you look at what the street is expecting is like the higher margin HBM at 60% taking share. So at Micron, you know, it's like from like sub 10% share to a bit more than 10% share. What I do expect is actually, like if you look, for instance, at the second half of this year, I expect gross margin to increase much faster, like 2-3 points faster than what the street is expecting, because we will see the shortage in other DRAM chips as well.
How much of the good news, though, is already priced in? This is a stock that has gained 95%, almost doubling since April 8th, the day before President Trump paused tariffs. And so far this year, it's up more than 50%. So you could say a lot of the news is already priced in.
Yeah, you're absolutely right, Scarlett. What is priced in is the HBM story. it's growing very fast, and it's much higher margin than the rest of memory. That's a very good story, and that's what really doubled the stock since the lows of Liberation Day. What the street is not anticipating and what creates a positive surprise tonight, and I think for the second half of the year, is the fact that margins are also expanding everywhere else.
I am curious, Pierre, we haven't really talked about the whole elephant in the room, which is tariffs and this idea of the U.S. trying to put some degree of curbs on U.S. technology. I know memory chips don't necessarily rise to maybe the level of the types of concerns that we would have, say, relative to some of those high-level NVIDIA chips. But does this become a factor that we have to start factoring in tariffs, export controls, and other potential costs or restrictions that could hamper that growth?
It's a good question. So memory has really been on its own trajectory on the tariff and export control front. Remember, like 2, even 3 years ago, the U.S. already put like import restriction on Chinese manufactured chips, and China retaliated against Micron already at the time. So Micron has already been out of China a lot. The player who is being hurt very significantly by export restrictions today is actually Samsung, because Samsung took the slack and had like a very big, especially HBM business in China, and that business got hurt very badly. But Micron, as a fab in the US, barely has manufacturing capabilities in China, and is actually on the right side of the tariff story in memory.
All right, good stuff. Pierre, thank you so much for joining us. Pierre Ferragu is managing partner at New Street Research. And of course, Micron will be reporting its earnings after the closing bell, and we will bring that to you when they cross. Obviously, the focus here is on that high bandwidth memory. Yeah. That's what it's all about. But it's super fascinating, that idea that the legacy chips will actually get a boost as well, because it can't devote as much time to producing those.
Yeah, and you're actually seeing some of that residual effect, at least based on what investors have been chasing. They seem to have kind of finally snuffed that out and realized that NVIDIA doesn't necessarily have to be the only game in town. It might be the best game in town, but not the only game.
Right. Yeah. I mean, although NVIDIA is back to where it was before, it's at a record high once again.
Absolutely.
Complete round trip.
And there was we didn't have a chance to ask him, but I thought there was a great note out today by Loop Capital talking about a potential $6 trillion valuation for a stock that right now is at below a $4 trillion valuation. So they see a lot of growth to come for that stock.
Yeah, pretty big runway for that company. All right, coming up, we're going to talk about real estate and speak with Jonathan Goldstein. He's CEO of Cain International. It's an alternative asset manager, about the opportunities that he is seeing in real estate, especially as return to office mandates continue to gain. Although I feel like in the New York area, it's in full force.
Yeah, except for today. It's like 110 degrees outside.
We're here. We're here every day.
That's right. Sweating it out for you right here on The Close. This is Bloomberg. .30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostic.
And I'm Scarlett Fu. I don't know, have you been to San Francisco recently?
I have, yeah. We were just out there in March, and the city's actually been rebounding. I was actually surprised. I hadn't actually been there probably since prior to the pandemic, and you'd heard all these horror stories. The downtown, all of that. Yeah, the downtown still needs some work, but you are seeing a lot more activity.
Yeah, and you can credit the AI boom for a lot of that, right? I mean, a lot of people are leaving the pandemic boom towns like Austin, making their way back to San Francisco, because if you want to be on the cutting edge of AI, you have to be where the talent is. Yeah, and you're seeing that reflected in a lot of the real estate out there, a lot of new projects going up, whether it's residential projects, some office projects, a lot of hotel projects as well, and a lot of it really catering to more of the high-end consumer, if you will. Maybe that's a reflection of their new mayor, of course, who was cut from that cloth. Absolutely. More homes sold above $20 million in 2024 in San Francisco than in any other year in history. Wow. And that could maybe accelerate further. Well, let's talk to somebody who knows a lot about what's going on in the world of luxury real estate. Jonathan Goldstein is the CEO of Cain International, an alt asset manager specializing in real estate investment across the U.S. as well as in Europe and the U.K. Great to see you.
Thanks for having me.
Let's start here in the U.S. because you've got a lot of projects, including in Miami. In May, I was out in Los Angeles at the Beverly Hilton, and there's this huge hole in the ground across the street from the Beverly Hilton that you are effectively in charge of here. Not just really a hotel. I mean, this is going to be kind of a whole complex, if you will, of, I don't know, what do you call it, entertainment, or what phrase you want to use for it. But talk a little bit about the design process and the thought process when you're building something like that, anchored by a really luxury high-end hotel like Amman, the type of customer you're going for and the type of experience you want that customer to have when it's built?
Well, it's a great question, and thanks for having me on. You don't often in your life get an opportunity to imagine what to do with 18 acres of a great city like Beverly Hills. And we brought on, some of the great advisors, led by Lord Norman Foster out of London and supplemented by Kerry Hill out of Singapore. And what we're creating is a new community for Beverly Hills. We're creating huge parklands, wonderful retail opportunities, and 2 great hotels, clubs, wild opportunities across the whole space. We've been partnered by very, very strong institutions, JP Morgan, Vici, and underpinning all of that are the brands led by Amman, with the Hilton, with the Beverly Hilton, creating a wealth of opportunities. So I think that when you get these opportunities, you have to try and look at it through the eye of the consumer, through the eye of your partner, the buyers of your apartments, the people who are going to stay in your hotel rooms, the people who are going to come shop and spend time and eat and drink at your facilities. And you really have to put yourself in their place and say, if I were them, would I like this? Is this what would attract me?
What do those people want? Like, what's most important to them now, and how has that changed from, say, maybe 30 years ago when you were kind of kicking things off in your career?
I think COVID was a great definer of people's times and people's lives. And people understood that they wanted experiences. They wanted to go places where they were understood, where they were treated properly, and they had great experiences. And getting involved with brands like Amman or the Delano down in Miami Beach, we've understood that we have to offer something to people. We have to offer opportunities. We have to curate them and tailor them for the individuals. We have to provide an oasis of wellness, of luxury, of safety and security and privacy, because that goes through it in this world as well. So we need to provide all of those within one space, and we're doing that at Beverly Hills, and we're doing that down in Miami as well.
So those are very powerful brands, Amman and Delano, but I'm wondering in terms of actually getting to build out those projects, what does that look like in a place like California and Los Angeles versus in Miami? I mean, you have environmental studies in California, you have a lot of regulation, a lot of red tape, a lot of stakeholders to please. Does it look a lot different in a place like Miami?
Well, first of all, I have to say that contrary to popular conception, we have a great partner in Beverly Hills in the City Council. From the mayor downwards, we've had great support from the very beginning. Our entitlement process was a smooth process. Yes, of course, there is give and take in that process. Miami, by contrast, has had a huge growth spurt, huge amounts of development. And I do think there are times when the authorities find it hard to keep up with the amount of approvals and the amount of sign-offs they have to give. We've been investors in Miami since 2016, and we've really enjoyed the growth spurt. We built the most popular office building since, probably for 30 years in Miami, 830 Brickell. We're 100% full of great brands like Microsoft and Citadel and Santander. So we've lived through this ramp up in Miami. And I think the important thing to understand is that when you develop in these great cities, it is a partnership. It's not just a partnership of developer and capital, but it's also a partnership of developer, capital, and the local authorities. And we have been lucky in both places, that we've been able to move with the authorities. On Miami Beach, for example, we've worked with the historical board to ensure that the historic piece, the globally known Delano Hotel, can be reimagined and brought back to its former glory, and we'll be opening it at the back end of this year. And that is a partnership again with the local people.
And you mentioned Brickell. I'm curious about what the environment looks like for office buildings, high-end office buildings there. There's so much talk about Florida being Wall Street South, and we've certainly seen a lot of financial firms, plant their flag in southern Florida. But I'm wondering how much of that is still happening at the same pace, given that we're 5 years out from the pandemic.
Well, I think that you haven't found many developers, developing speculatively the same way that we did at 830 Brickell. Obviously, you've got Ken Griffin working on his plans at Citadel for, where he's bought the land and he's bringing that forward, and I'm sure that will be a resounding success. But we're seeing that there's actually a dearth of opportunities in the market. There's a scarcity of new supply. What we're seeing in the world today, we're seeing a return to the office, which is right. It's good for the people and it's good for business. But in order to get people back to your office, you have to provide a fully amenitized space, which means that the secondary office blocks, those that are 30, 40 years old, simply cannot provide that opportunity to people and really reward them and make them feel valued being at the office. We're lucky we've been able to develop that. 30 stories up in the sky, we've got the most amazing gym, cafe, etc.
I am curious geographically where you see the most opportunity right now. Let's just take South Florida and Beverly Hills, LA out of the question. Setting those aside, I mean, where do you see the most opportunity to build long term?
We've been strong investors in the US in the course of the last few years. I mean, obviously the last few months has been a wave of news and a wave of stories, and I think everybody.
Does that rattle you? Does that change your outlook?
It hasn't rattled us because we've looked at the actual reality of rather than the noise coming out of all the stories and the media obsession. And I don't mean that in a critical way because we're all obsessed. But I think you need to look at the reality of what's happening on the ground rather than the noise around it. So we've been strong and we continue to be long US. There's no doubt that Europe has gone through a difficult patch. Certain countries in Europe you would be more cautious of, but the Southern Europe opportunities are strong, there's Spain and Italy. And then you have to look at the Middle East. There are pockets of huge growth within the Middle East, within Dubai, with Abu Dhabi, or within Saudi or Bahrain. We've just entered into a partnership with Mubadala Capital to help grow into the luxury space in that way, because we see huge opportunities across the world, but we do see ourselves diversifying whilst remaining strong in the US into those other areas.
All right, Jonathan, this was a fascinating conversation. Great to have you here.
Thank you for having me.
Jonathan Goldstein is the CEO of Cain International. Stick with us. When we come back, we're going to talk about those rumors surrounding Shell and BP. It's our Stock of the Hour. It's up next. This is The Close on Bloomberg.
Shell is refuting speculation that it is in takeover talks with fellow energy giant BP. BP's American depository receipts surged on the report but have pared their gains, though still up about 1.6%. Shell fell on the initial report from the Wall Street Journal, pared its losses, but still remains in the red. Let's bring in Will Harris of Bloomberg Intelligence right now to give us some more context. Will, this report follows on Bloomberg reporting a couple weeks ago that they were looking at a possible tie-up here. Even though Shell has refuted this, why would a tie-up here make sense?
Well, yeah, I think it's pretty important to first place that it has been refuted, although there's been a lot of anticipation and headlines around this, suggesting there's a kernel of truth here. And we probably think that a full takeover is probably unlikely. It's a big ticket item. BP is valued at $80 billion. With a premium, you're nearing $100 billion for a full acquisition. And this would come with major antitrust issues, synergy realizations going on for years and years, and obviously cultural integration problems potentially as well. A full takeover is quite unlikely for those reasons. We think the kernel of truth is more likely something to the degree of Shell being interested in a piece of BP, one of their segments. Shell probably won't be interested in some of the lower return energy transition, renewable power businesses that BP has made a relatively large share of their portfolio recently.
I am curious just about the idea, Will, of sort of what the net benefit would be for both companies here, particularly for one company that has been, I guess, relatively restrained when it comes to shelling out a lot of money, pun intended, for acquisitions.
Well, I think first and foremost is obviously scale, efficiencies, costs, trading ability. So all of these will definitely provide benefits to the acquirer. BP has also suffered terribly on valuation. It's underperformed the peer group significantly on strategic issues, management reshuffles. They've been flip-flopping on their energy transition pace for a while. So you could see this as an opportunistic time for an acquirer to get some somewhat discounted assets. But however, I think people are still underrating the key hurdles here for an M&A transaction of this size. We're looking at 100 billion. It would be one of the biggest deals of the last 2 decades. So there's a reason why I think it hasn't happened yet.
Okay. Very quickly, Will, does Shell need to do something in order to better compete against Exxon and Chevron?
Well, yeah. So the CEO Wael Sawan of Shell has made it really one of his priorities is closing this valuation gap that exists across the Atlantic Ocean. Exxon and Chevron trade at roughly a third higher than Shell, and narrowing this gap is one of his key objectives. We think that, bulking up in scale it could be one lever that he could pull there. Now, buying BP is probably still, we think, is relatively unlikely. I would note that Shell has been very, very disciplined in its capital allocation in the last several years. And I think this is in big part why it's actually outperformed BP so much. So a big deal would be pretty out of character, I think, for this management team from Shell at the moment.
Got it. Will, thank you so much. Will Harris of Bloomberg Intelligence. From New York, this is The Close on Bloomberg.
Uncertainty still abounds, right? We started the show with that. We see it every day. And so I think investors are really looking for, can I get past some of the headline risk that we see to push out the curve?
Alex Petrone at Rockefeller Asset Management kicking us off to the close just about 50 minutes ago with an eye on the markets. The VIX down, yields down, Scarlett. So too are, the dollar as well, and the markets. Equity markets not doing much of anything.
Not doing much of anything. The S&P 500 basically flat. So we are still looking at potentially it making a new record high. Not there yet. The NASDAQ 100 is. But what is flying high is NVIDIA, and that's helping to lift the Philadelphia Semiconductor Index overall. Yeah,
I kind of feel like that's the only thing, at least along the big mega cap names, that's really helping to sort of bolster this market. And it gets to the question, sort of what gets us, the S&P, to that record high, and more importantly, what pushes the NASDAQ a little bit higher above that record high that it set yesterday.
I fear we need to wait until the start of earnings season, which is another 3 weeks away.
Yeah, it's another 3 weeks. Yeah, and we should point out, I mean, we're headed into a little bit of a doldrum here, of course, with the July 4th holiday week for a lot of people coming up. And of course, earnings season doesn't start really to mid to late July.
That's right. And of course, it takes a while for that to get started, too, because at this point, the banks aren't going to really move the market. It's going to be the big tech companies that do. Absolutely here. And don't forget, we are awaiting earnings. Earnings season never stops. Micron, one of the stragglers from the last earnings season, they report after the bell tonight as we keep an eye on the market action, moving closer to those closing bells with just about 8 minutes to go. Joining us right now is Leo Kelly, the CEO of Verdence Capital Advisors. Leo, record high yesterday on the NASDAQ 100. The S&P posted some pretty strong gains, and it's only 50 points or so away from claiming another record high. Do you think this sort of round trip, if you will, from where we were just, I don't know, a couple of months ago is justified?
Absolutely justified. I think we've just made up a lot of ground that we probably would have covered without that tariff disruption, if you will. I think it's been a little bit indicative of the market as of late. And that speaks to a market that is at higher valuations and starts to price for, let's call it, a little closer to perfection, that when you get these disruptions like the tariffs, the market starts to behave a little bit more defensively. Specifically, what we have seen is the market seems to be taking short-term issues and they're projecting them out to be long-term. I think that's what happened with the tariffs. So what we heard when the market went down was we're going to have inflation and the tariffs are going to turn into a bigger and bigger problem. And really what it was just a negotiation on the part of the Trump administration with its trading partners. And we've settled back down again.
There's a question, though, particularly when it comes to the tariffs. I mean, the president has made clear that there will be higher tariffs than when he came into the office, at least based on those baseline rates, assuming that there aren't a more constructive deal struck. And it gets to this idea of whether the worst was already kind of priced in, not only on tariffs, but concerns about the economy, concerns about geopolitics and the Mideast, et cetera, whether that was already kind of priced in a long time ago. And that might have been a reason why you saw such a huge upswing when it became clear that the worst case scenario weren't necessarily going to materialize.
Yeah, I think what we really saw, Romaine, was confusion. I think we saw the market unable to price assets because Donald Trump is the negotiator in chief, right? He's going to push the limits out as far as he can, and it's not necessarily to get to that limit, it's to move the center closer to him. And so in doing so, you had a market that really didn't understand where he wanted to land, and so they couldn't price assets. I think that was really one of the big issues. And what's happened over the last few months, while we don't know specifically where tariffs are going to land, we have a range and we can price assets again. I also think, by the way, that during that doldrum, that period of doldrum and concern, we probably saw quite a bit of slowing in the economy, and that probably affects earnings for a quarter. And that's why you're seeing a lot of companies have been reducing estimates, and earnings estimates have come down. Wouldn't be surprised if the back half of the year, now that we have some certainty and things are kicking back up again, that we get those earnings maybe start to revise back up.
Right. If nothing else, we have a little more clarity because there's fewer quarters to project out as opposed to 4 quarters down the road. We know where the president wants to land when it comes to fiscal policy. That tax and spending bill is making its way through the Senate right now. There's a self-imposed deadline of passing it by July 4th. How much of that is priced into the market? Let's just say that the Republicans get everything through. Is that going to generate any kind of response in equities?
I don't think so. Again, I think what we're seeing again is the current trend is everybody wants to look at the marketplace and look for the next big move up or down. And a lot of these situations are really priced in. And I think we have to start to get back to separating what is news versus what is economic impact. An example, of course, is we look at the bunker busters in Iran and what happened over the weekend, and people coming to the marketplace on Monday and saying, my goodness, what's going to happen here? And nothing happened. I think this similarly, the market expects a deal to get done. Whether it happens on July 4th or it happens on September 1st, the market expects a deal will get done, and it will. The tax breaks, if you will, from the past will be held. We don't know what's going to happen around the edges, but something will happen. And so I don't know that this is a big economic factor. I think the bigger economic factors are that the consumer has slowed down and is struggling a bit. Housing numbers have not been good. I think the Fed's got a struggle in front of them because inflation is not going away no matter how bad we want it. So I think we need to focus on what is important, what actually moves markets, and move away from some of the headline topics, quite frankly.
Okay, so that being the case, given what Jay Powell has said in 2 days of testimony, are we priced right now for a rate cut in September? And if something comes up earlier than that, according to 2 Fed governors, there's a possibility for a July rate cut. Would that provide the catalyst for that big breakout move?
Yeah, I would be shocked if they did it in July. I think that the Fed understands. They have done, and I might be in the minority here, I think they've done a good job here with managing what is a very, very difficult inflation issue. We talked about this when I was on the show last time, that M2 has exploded in the marketplace over the last several years, and every time M2 grows, inflation goes up, and when M2 retracts, it starts to go back down again. The issue here is a money supply problem, and the Fed can't fix that overnight with a rate cut or two. And so they know that inflation is a bigger issue, and M2 has been growing again, and they see that. So I don't think they can do it in July. I think it's a possibility in September. But if the economy heats back up, if we come out of the tariff malaise, then I don't know that the Fed can cut rates. Again, this is like the 3rd year in a row I've heard everybody say 4, 5, 6 rate cuts are coming. They just don't come, and there's a reason, and that's inflation.
All right, Leo, always a pleasure. Leo Kelly, the CEO of Verdence Capital Advisors, as we count you down to the closing bells with just about 2.5 minutes to go. Stocks pretty much holding where they've been for quite some time. The S&P unchanged, the NASDAQ fractionally higher, Scarlett.
And the Russell 2000, the laggard here, down more than 1%, although tech is really the reason why the S&P 500 is little change. Everything else mostly is down.
360 names in the green and the red right now, but big tech is out in front. A full breakdown of all of today's market action starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu, taking you through to that closing bell with a global simulcast that starts right now. There's Carol Masser. There's Tim Stenovic in the radio booth, illuminated, as we welcome our audiences across all of our Bloomberg platforms, including our partnership with YouTube. Carol Masser, intraday day in the market, 6,091 on the S&P 500. 19,996 right now on the NASDAQ composite.
What a different day from yesterday, right? We had a full-charged rally, and today just feels like a sideways move. And I don't know, is it investors questioning so much that happened yesterday? I don't know. It's just a weird day of trading.
A narrow range, and for much of the day, stocks searching for direction. In the S&P 500, stocks were as high as 0.3%, down as much as 0.2%. And look at that. Unchanged as we speak.
Yeah, but a big breakout move for NVIDIA, which is closing, or it's set to close at a record high. So completing this huge comeback from losses tied to, remember, DeepSeek and China tariffs earlier this year? It's not even a factor now.
I didn't want to say it because it might be one of Carol's gainers.
Okay.
You know?
You can say it.
That's all right.
Is that okay?
It's NVIDIA. Come on.
It's NVIDIA.
All in on NVIDIA.
And it gets to this idea, too. We talk about the chip trade, the semiconductor trade, the AI trade, if you will. Just a reminder, we do get Micron earnings after the bell. A different complexion to that trade, obviously, when we're talking about memory chips as opposed to the high-powered chips that NVIDIA makes. But it's all the same ecosystem, and it's all the same trade, and it's been doing well.
And the other thing I would say, if you look at the stocks, I assumed with NVIDIA up, everything was going to be up, but that's not the case. 20 names are higher, 10 to the downside, and the stocks little changed compared to what we're seeing in NVIDIA today.
Yeah, but some notable gainers today, like NVIDIA, Coinbase also trading at a record high here on the day, but nevertheless not enough to really bump this market that much higher, with the Dow Jones Industrial Average sitting this one out, down about 0.2%. We're going to call the S&P unchanged on the day. It takes a while for these numbers to settle. It did open above 6,100, but it is going to close below that level here on the day, relatively unchanged from where it ended the day yesterday. The NASDAQ composite up about 61 points, or 0.3%. The NASDAQ 100, a fresh record high, up 0.2% on the day. And the Russell 2000, that's your primary laggard, down about 1.2%.
All right, back to the S&P 500 I go. And you've got, as I pull it up on my terminal, 366 names to the downside, 137 to the upside, Scarlett. So definitely more of a risk-off trade today.
Yeah, and when you look at the IMAP with its 11 sectors, only 3 of them finishing in the green. Tech up by more than 1%. Communication services gaining half of 1%. Healthcare marginally higher, but everything else is down. And the big laggard here on the day was real estate investment trust, losing 2.5%.
All right, let's get to some of the individual gainers, if I may. And got to talk about BP today, folks. At its highs, up more than 10% in today's session, finishing with just a gain of about 1.6%. The ADRs that trade here, the big energy giant, oil giant, they rallied on a Wall Street Journal report that Royal Dutch Shell is in early talks to buy BP, which is considering the approach carefully. We did then have Shell come out and say, nope, we're not looking to do this. But there's been lots of speculation, and activists has been pushing for some changes at BP. So this is something we're going to watch. Keep in mind that Bloomberg also had reported, I think back in May, that Shell had been studying the merits of a deal. So we're going to keep this one on our radar, but not as enthusiastic, but still with a gain of about 1.6%. Chips, we mentioned it. Micron going to report after the closing bell. AMD, an outperformer today, up about 3.5%. We saw that moving. Your second biggest gainer in the NASDAQ 100. CFRA yesterday upgraded the chip maker to strong buy from buy, up the price target to 165 from 125, stock closing at 143 and change. Angelo Zeno saying in a note that AMD is closing the competitive gap with NVIDIA. And we've got Micron.
Micron earnings crossing the wire. 3Q adjusted operating income, $2.49 billion. That is a beat. The street was looking for $2.13 billion. Cash flow from operations coming in slightly below street estimates of $4.61 billion. Adjusted EPS does beat the bottom line number for the quarter, $1.91. The street was looking for $1.60 on average. And the top line number, revenue for the fiscal third quarter, $9.3 billion. The street was looking for $8.85 billion. And gross margin also coming in above estimates at 39%. The street was looking for roughly about 37%. Now, for the current quarter, the fiscal fourth quarter, the company is guiding for a revenue range of $10.4 to $11 billion. The low end of that range is significantly above the average of street estimates. The street, Scarlett, was looking for $9.89 billion.
Yeah, so that is a beat, and you're looking at the stock gaining more than 6% in after-hours trading. Fiscal fourth quarter revenue, you mentioned that it's a range of $10.4 to $11 billion, higher than the consensus estimate of $9.9 billion, projected to grow 15% sequentially. So once again, it underscores the demand there for these high bandwidth memory chips that Micron makes. And as Pierre Ferragu was telling us earlier, Carol, this idea that it has to meet demand for that means that it makes fewer of the DRAM and the NAND chips, and so it has a better supply-demand equation for those legacy chips as well.
Well, listen, they're a key beneficiary of AI computing gear spending, right? Their growth, those high bandwidth memory chips, they're in high demand, right? As you said, they've been driven up the prices due to supply constraints, but you are seeing that they're playing into that AI trade. What I want to point out, though, you've got the stock up almost 7% in the aftermarket. Shares have roughly doubled since the S&P bottom back in April. So this was a real test. They had to outperform here, and that share price move shows that
just real quickly, too. I mean, there are more numbers coming out here on the forecast, specifically an increase, a widening of gross margin projected to be about 41% for the current quarter. That's plus or minus 1 percentage point. That's well above street estimates. And then diluted earnings per share, Tim, $2.29 a share is the guidance, plus or minus about 15 cents, also coming in above street estimates.
Okay, so we'll wait till the earnings call to get more commentary, but Sanjay Mehrotra is saying that we're on track to deliver record revenue with solid profitability and free cash flow in fiscal 2025, while we make disciplined investments to build our technology leadership. And get this part, guys, manufacturing excellence to satisfy growing AI-driven memory demand. So they're still saying, yeah, there's been a lot of demand. There were questions about demand moving forward, and we're going to work to deliver on that demand.
All right, so interesting, some optimism. I was trying to take a look. It looks like AMD is even maybe moving in the aftermarket, so we'll keep a watch on that chip space. I'm going to go back. I mentioned AMD already. I want to go to NVIDIA because, as Scarlett mentioned earlier, an outperformer today, up more than 4%, pretty much finishing at its highs of the session, and I believe that was a record close for the company. Yes, indeed. NVIDIA's price target lifted to a street high of $250 from $175 over at Loop Capital Markets, who says that the chip maker is positioned favorably into the next golden wave of generative AI adoption and can reach a $6 trillion market cap for the company. Right now, the market cap at $3.7 trillion, so some outperformance. And I'm just going to throw in Alphabet, if I can, up about 2.3%. This was a top gainer, too, in the S&P and NASDAQ 100. Alphabet's Google launching Gemini CL1, I believe it is, or CLI, an AI coding assistant to ease the work of developers and catch up with some rival products. So, again, some outperformance there, Tim. What do you got for decliners?
I want to start with FedEx, down 3.3% today. It fell close to 6% earlier in the session, bounced off those lows. The company warning that its profit will be worse than expected for this quarter. It declined to offer guidance for the rest of the year due to the uncertain global demand environment. Also, General Mills falling more than 5% today. It's the worst single day going back 2 years to June of 2023. The company projected a lower adjusted profit for the fiscal year ahead. Cautious consumers is what they say they are finding. Those cautious consumers are limiting their grocery expenses. And here's an interesting one, a New York City-focused decliner, Flagstar Financial. Remember, this is the company formerly known as New York Community Bank. Shares fell 3.9% today. This is due to its exposure to the rent-regulated market as a result of Zoran Mamdani's upset last night. As he's set to become the Democratic nominee for mayor of New York, he's called for a bold progressive agenda, including rent freezes. And that bank is heavily exposed to the rent-regulated market. Shares fell 4% today.
Just a quick check on yields. Not a whole lot of action there, but 3 straight days now that we've seen yields fall on the shorter end of the curve, down about 5 basis points on the 2-year. The long end of the curve, you can see much different, and that's contributing, of course, a lot to the steepening that we've seen as of late, guys.
Yeah, and listen, we're just taking a look again as Micron continues to move higher. We've seen some other ones. SanDisk, Western Digital following Micron higher in the aftermarket. SanDisk up about 2.9%, 3.5%. So we are seeing their news lift a couple of other names in the sector.
NVIDIA as well, so building on that record high, now up by 0.4%. Of course, we'll wait to get more details from the earnings call, but clearly margin expansion is what investors were fixated on. Yeah, and just real quickly before we go, another headline crossing the wire, this on a software stock, Asana, new CEO at that company, Dan Rogers.
Yeah. So, okay, a little bit of earnings. I feel like, wait, we're just getting the last, little
last
bit
gasp
right before we start in JP Morgan.
Yeah,
in
July
a couple
15th.
Of weeks.
July 15th. Mark your calendars.
All right.
15th?
It's
going to be a long 3 weeks until then.
Nothing's going to go on. It's been so quiet. All right, guys.
I hope something goes on. We have to talk every day.
July 9th is another date to keep in mind.
What happens July 9th, Tim?
I just want to...
It's the end of the 90-day pause for many of these countries when it comes to tariffs.
I predict it'll be extended by 2 weeks.
That's what your prediction will be?
Yeah.
I think the extension will be longer than 2 weeks.
The uncertainty continues. Thank you very much, right? It'll just continue.
Keeps us busy.
All right, that's a wrap across platform. Radio, TV, YouTube, Bloomberg Originals. We call it the closing bell. Romaine and Scarlett continuing there on TV. Tim and I back here on Bloomberg Business Week Daily. Guys, we'll see you again. Same time, same place tomorrow.
And our coverage continues right here on Bloomberg Television. Micron apparently, well, pleasing investors here. As you see the post-market trade there up about 5%, a full breakdown of the earnings report that we just got. This is Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. You know, coming off a day like yesterday, we had such monster gains. Sometimes you get a day like today where things are, well, unchanged. The S&P 500 pretty much ended the day pretty much right where it started. Remember, it did open up above that 6,100 level, fell back just slightly below that. Right now in a holding pattern. You saw a little bit more strength in the NASDAQ indices, but that was because you got a big lift out of NVIDIA, and that's a big part of the reason why you saw this Philadelphia Semiconductor Index up about 1% on the day. Meanwhile, transports were down on the day, and that was largely because of a big drag coming out of FedEx, some disappointment with their earnings that we got yesterday. And Bitcoin doing what Bitcoin does, continuing to find a little bit more firm footing back above that 107,000 level.
Romaine, you mentioned disappointing earnings. There's another name that we need to tell you about, and that's Paychex, down almost 10% on the day. That is the biggest decline since March of 2020. Its latest revenue and profit estimates, or profit, failed to exceed estimates, so it only matched, and that wasn't enough for investors. Guidance was also a little bit light. We also saw competitors to Paychex like ADP and Paycom falling in sympathy. He also mentioned NVIDIA. That stock closing up about 4.3%, a new record high. So completing this comeback from losses tied to DeepSeek from China and the tariffs earlier this year. NVIDIA also held its annual shareholder meeting today, and the CEO, Jensen Huang, reassured investors that demand remains strong and the industry is only at the start of a massive AI infrastructure build. Romaine?
All right, and we should point out NVIDIA still adding to those gains in the post-market trade, and part of that is because of what we just learned out of Micron, the memory chip maker, reporting earnings just a little while ago. The company saying that in its most recent quarter, it had a 37% bump in revenue. Adjusted EPS came in well above estimates, and it gave guidance for the current quarter, its fiscal fourth quarter, that also beat estimates across the board, $10.4 to $11 billion in revenue. That's its guidance on the top end. On the bottom line, $235 to $265 on the EPS side, also well above street estimates. Joining us now to help break down where Micron might go next is Kim Forrest, founder and chief investment officer at Bokeh Capital Partners. All right, Kim, let's first start with the quarter that was. I mean, we were expecting strength, largely because of this golden wave, if you will, of AI infrastructure. Were these numbers in line with what you were expecting?
Kind of, but I think they really eclipsed what I had thought they could do in this quarter. Remember, the chips that are driving their earnings higher are sold out for the end of this year, which is next quarter. So they're already booking next year's 2026, high bandwidth memory orders. And it looks like they're confident enough to be able to deliver these products and raise their earnings even more in the next quarter. And I think that bears well for whatever's going to happen after that.
Well, this is what I'm curious about. As you know, a lot of the negative Nancy's out there are really sort of looking for any canary in the coal mine that would sort of knock this data center AI boom off its rocker here. When you look at what Micron has to say today, does that give maybe some ratification to the idea that there is a lot more room left in this data center build out, this AI infrastructure build out? And how long, how much of a runway do you see?
That is a tricky question. Your second question is how long. Nobody really knows. And here's why. While I believe that we are in, we'll use baseball terminology, maybe the second or third inning at this point, we don't know how fast the game is going to go. Right now, companies are building the large language models and large reasoning models, which, as the name implies, are large, and they take tons and tons of data center space to make it, to build these models. But my worry is, I don't really understand how many of these we're going to actually need, because companies are going to start building their more tailored models on top of these things. So that's the big question is, what does AI really look like in the next 5 years? And nobody knows. But I know one thing, it's probably not going to look like we think it is right now. It never does.
It never does. So where does that leave a company like Micron? I know that when we're talking about the AI story, it's very much the high bandwidth memory chips, but they also have legacy chips as well. And the high bandwidth memory chip is just a small part of its business. So even though that part of the market, that part of its business is seeing high growth, where does that leave the legacy chips and how much leverage it has on that front?
Well, that's a great question. And I think the roller coaster of anybody that has been an owner of Micron can answer that this is a really constrained little area of the chip manufacturing. There's only a handful of companies that make NAND and DRAM. So whenever somebody brings on new capacity, it kills the pricing of the whole environment. So I think that will continue probably, but I also believe not only is AI data center going to drive demand, but you know what? We're going to want to have more real devices connected to these data centers that are not only feeding the data centers with information to process, but also answering questions about how should this pipeline run and all of the questions that things are going to hook up. Real life computers are going to hook up out in the world, and Micron and even companies like AMD's older products and God forbid Intel's products, they might be used out in the world, not in the data center. So it looks like semiconductors are going to be a hot item for the next, I don't know how long, a long time.
We saw NVIDIA today reclaim its record highs, making that round trip back. And of course, Micron has more than doubled at this point since President Trump paused the tariffs. If you're an investor in these names and you don't want to be adding to those positions, but you want to buy into the AI story, do you then go to an AMD or an Intel, the legacy chip makers?
Probably not. I think the people who are in AMD right now, I'll be a psychologist here, are probably momentum lovers. So they're going to try to find things that are more like Micron, that are driven by momentum, right? Mm-hmm. Even though they're somewhat limited. And I think we see that in after hours market with the other NAND and DRAM players that are public, Western Digital and I forget the other one. Sorry, I drew a blank. But, I think the more momentum names will probably get the love. But I think investors who are a little patient might want to look further down the semiconductor chain to continue to play in this area, because this is where the chips are going to go. As I said, we need, it's not just people asking questions on iPhones and Android phones, it's going to be devices talking to each other. And that machine chatter is going to drive a whole bunch of investment, not only in computing, but also in bandwidth. So I would look into telecoms as well, because, we have to get the information to and from the data center, and that would be telecoms.
Kim, always a pleasure. Kim Forrest is founder and CIO at Bokeh Capital Partners. Coming up, we're going to switch gears and look at geopolitics. President Trump declaring the Israel-Iran war over. A heavy hitter here weighing in next. Ambassador Wendy Sherman. She is a former U.S. Deputy Secretary of State. Coming up on The Close right here on Bloomberg.
We call it the 12-day war. Spoke to a few people. I guess that just sounded like the right name. It was a 12-day war. And we think it's over. I don't think they're going to be going back at each other. I don't think so.
That was President Donald Trump speaking at the NATO summit in The Hague earlier today. He also said the U.S. and Iran will speak next week and that an agreement with Iran may not be necessary to ensure peace. Joining us now, I'm pleased to say, is Ambassador Wendy Sherman, the former U.S. Deputy Secretary of State. Ambassador Sherman, thank you for joining us. You were the U.S. top negotiator with Iran back in 2015. If the U.S. and Iran resume negotiations on the nuclear situation there in that country, What advantages does this past weekend's bombings give the U.S. in this next round of conversations?
Look, Scarlett, first of all, our military showed how extraordinarily capable it is. That was important not only in this situation, but to say to the rest of the world that our military still remains the most superior in the world, a good message to China and to Russia and to others. Secondly, it's good that we have this ceasefire. Peace is always better than war. But we don't know what the future holds here. It's still not clear whether Iran has secreted away most of the 400 kilograms of enriched uranium at 60%, which can be enriched further to 90% weapons grade. We don't know whether all their centrifuges are destroyed or whether some are secreted away as well. We don't know whether they want to be able to continue an enrichment program, which was the red line for Iran, and complete dismantlement was the red line for the United States. If we have a negotiation, it might mean that the International Atomic Energy Agency, which may get booted out of Iran right now, its legislature just voted that that should happen. There's still a decision to be made by the executive branch. But the International Atomic Energy Agency would have eyes on what's going on in Iran, would tell us, give us a better chance of knowing if something was happening covertly, would make sure that it was peaceful until hopefully they did dismantle any remaining program they might have. But the reason that negotiations matter is that you cannot bomb away knowledge. Iran knows the entire nuclear fuel cycle.
Yeah.
So although it may be set back, it can recreate its program.
Well, that's what I'm curious about, Wendy. I know there's a lot that we don't know about the Israeli operation, but there have, of course, been a lot of public reports that Israel deliberately targeted some of those scientific minds, and they're claiming that a lot of those folks have been killed in various strikes here. Is that a strategy? I mean, I know that this idea of, okay, that knowledge is out there and that knowledge carries forth, but if you can do enough damage to the people who do have that knowledge, does that constrain the ability of whatever the Iranian regime that's left to actually enrich this uranium and maybe potentially make a nuclear bomb?
Well, it certainly doesn't make it easier. That is a fact. But Iran is a country of 90 million people, and the supreme leader has deputies upon deputies upon deputies. It is an industrial society. It is a literate society. And so it has a large middle class. So yes, although there's no question the facilities were damaged, if not truly damaged, many of the leaders were decapitated, and some of the scientists, of course. So it makes it harder, but it doesn't make it at all, sadly, impossible.
So much of what we're talking about here are known unknowns. We recognize that we don't know the answer, but we know that these are risks and they're possible. What are the unknown unknowns that you worry about, Ambassador Sherman?
I think what I worry about most is what most analysts worry about. And I'm not a nuclear physicist, but those who are do worry that those 400 kilograms of 60% enriched uranium, which is not far from the 90% you need from weapons grade, was somehow taken away. They can be cylinders put on trucks. It's not hard to do. That in fact, the centrifuges, that some of the centrifuges that are put in cascades that further enrich that uranium are hidden away somewhere. Iran had even told the IAEA, excuse me, that it was creating some additional sites, and they are likely to be underground. So my worry is that they will recreate their program, may already be doing so, and do it underground and in secret. I'm sure we have assets. I'm sure Israel has assets. I'm sure the IAEA, as long as it can be there, could try to figure out what was going on. But it is of great concern that they will reformulate their program. I hope it's years away. I don't think we have all the intelligence we need to know what has occurred here. And quite frankly, one of my concerns, Scarlett, is that we get straight intelligence, or at least our intelligence committees on Capitol Hill get straight intelligence.
Yeah.
And that we not turn this into a political back and forth where we don't know the truth.
Yeah, well said. Wendy, we have to leave it there. Really appreciate you taking time for us. That's Ambassador Wendy Sherman, former U.S. Deputy Secretary of State. All right, a lot more coming up here on the big program. We are going to continue talking about the geopolitical landscape, a volatile geopolitical landscape, and how the C-suite is adjusting to the new world order. Kevin Kajwara is Ceneo's co-president of Political Risk Advisory, and he joins us next. This is Bloomberg.
The business community is moving toward greater clarity, but we're not quite there yet. And most business leaders I talk to are already planning for how much they're going to negotiate with suppliers, how much will they take out of margin, how much, if any, will be put into price.
Former Dallas Fed President Robert Kaplan speaking a little bit earlier on Bloomberg Television. Of course, this comes on the same day we heard from Fed Chair Jay Powell telling Congress that he's waiting to gauge the impact of tariffs on U.S. businesses. Let's get a view from the C-suite and how they're navigating the uncertainty, the certainty, and then back to uncertainty. Kevin Kajwara is co-president of Political Risk Advisory at Ceneo. Kevin, great to have you here. The tariff situation is tamped down just a little bit, at least in terms of the rhetoric, at least in terms of the fears. I know we still have this kind of July 9th deadline sort of looming over all of this. How are folks in the C-suite feeling right now about their ability to either source supplies or export their materials in a way that is efficient and profitable to them?
Well, I think they're very concerned that you're right. It has sort of tamped down, but I think it's part of that is a function of the fact that there's a limited bandwidth, right? I mean, everybody over the last weekend was completely focused on how bad the Middle East situation might or might not get. And, you know, there have been a lot of other issues on the table, the fiscal bill, et cetera, et cetera. Well, all of a sudden, again, looming out there a week and a half away from now is, of course, the snapback of the reciprocal tariffs, not to mention the fact that there might be legal challenges to that. And as you know, what was promised was 90 deals in 90 days. We have one sort of deal with the UK. We've got a ceasefire agreement essentially with the Chinese, but there haven't been any major deals. So I think that a lot of the C-suites are they're cognizant of the fact that market pressure may return to the issue, and you know that you can't straight line where we are right now.
I mean, it's kind of weird because we're talking on a day where the markets are either at or near record highs. Yet yesterday we had a big earnings report out of FedEx where they basically said we can't provide forward guidance right now because of the uncertainty around tariffs, yet markets in theory are supposed to be forward pricing mechanisms. And I'm wondering if there is a disconnect between what you're hearing in the C-suite and what we're seeing play out in the markets.
I would listen to what FedEx said. I mean, they are living it every single day, and they can see the trends that are building in all of the international markets. Who companies are, you know, able to source from easily, where there are holds up at ports of entry and the like. I think they've got you know, a superb view on this, so I would listen to them pretty carefully.
I'm not sure where you were on Saturday night, but I think a lot of us, of course, got those alerts on our phone about the U.S. getting involved in those Iran strikes. And there was a lot of concern about what it would mean for markets. But more importantly, this idea that now CEOs and CFOs and other folks in the C-suite now have another thing that they need to worry about and maybe sort of plot out. If there are disruptions to global trade, if there is some sort of reflaring, I guess, if you will, in the situation in the Middle East, how are they actually preparing for that right now?
Well, I'll be honest with you. I was at my son's high school graduation when it broke, so, you know, just my luck. But I think the bottom line here is that CEOs have learned over the last, you know, several years now, really going all the way back to COVID in particular, but they've got to run some triage, right? I mean, the reality of it is that there are a lot of balls in the air right now on issues that can, will, or might be able to impact them and their businesses. We've talked about some of them already, from the fiscal bill, the tariffs issue. And then, you know, things like the Middle East. You may have people in the Middle East. You're going to be impacted by energy prices and the like. So I think very quickly they had to ascertain whether this was going to blow up into something very big, which, by the way, there was a very big risk of that happening, or whether it would get tamped down. Now, my point today would be don't straight line anything. This is not a fire that is completely out. There's a lot of unknowables, as Wendy Sherman just talked about in the previous segment as an example. So, you know, the point is that, but at this moment, it seems to be tamped down. You know, there's not going to be an eruption of oil. Both Israel and Iran have rationales and incentives to stand down for a while, but we have kicked the can down the road.
Yes.
This is going to be, I mean, ceasefire is not a peace deal, and ceasefires have a way of flaring up in that part of the world.
You use the phrase kick the can down the road, and you can kind of apply that phrase to a lot of things that have been coming out of Washington and out of other governments as well, including on tariffs. And I do wonder if that makes things even more difficult for CEOs, because at least if you have some disruption and you know that at some point it is going to be resolved, you can plan around that. But when you start having trade deadlines, you just keep getting moved back. And then, of course, now the situation in the Middle East, we have no idea what Iran's response might be. What's the adjustment?
Well, Romain, I think we've talked about this on the show before, that uncertainty is a tax in the sense that it perverts otherwise, what would be your normal economic behavior. So the longer you kick that can down the road, that uncertainty persists, that delays your ability to make significant strategic decisions. You're making a lot of tactical decisions, but those strategic decisions keep getting delayed. And if you think about what CEOs were thinking coming out of the election, that this was going to, unleash animal spirits.
Yeah.
But now in the interim, there's this kind of disruptive period that they're having to go through. That there's the opportunity cost of not having unleashed those spirits earlier. You're not going to be able to recover that. So it's just going to take, it's going to get kicked further down.
I want to bring the conversation back to very local here, and I just want to ask you a quick question about the results of the Democratic primary here in New York City, which for our viewers, for the most part, determines the general election. There was a lot of concern in the business community and Wall Street about the potential election of a very progressive left-wing candidate who wants to do a lot of things that, at least in the business community, they feel would maybe be anti-friendly to them. This isn't unique to New York City. We've seen this in other cities. We've seen this in other countries. And I do wonder if CEOs have that potential risk on their radar. Not that it's sort of the end of the world, but that it may alter their ability to do business in the way that they want to.
Well, look, I think that, if there's one thing that's been a hallmark of elections in the developed world and in the United States since the turn of the 21st century, it has been an anti-incumbent fervor, right? And so I think there's a lot of different ways. The jury is out on this. He is not the mayor yet, as an example. There are a lot of people who take maximalist approaches during the campaign and then are brought into reality. There's a lot of power centers in this city, as an example, right, that could temper some of those extreme views, and he's going to need the tax base to accomplish a lot of what he wants to. But there was also another kind of, if you want to look at sort of a silver lining, perhaps, is that this statement that the Democrats around the country needed to move beyond the old generation, move to that next generation. Look, there's going to be winners and losers in all of this, but this need to turn over a new leaf might have been a part of this as well.
All right, Kevin, I have to leave it there. Always a wonderful conversation. Kevin Kajwara, co-president of Political Risk Advisory at Ceneo. All right, here on this Wednesday afternoon, you did have markets that really could not extend the rally from yesterday. The NASDAQ 100 did add about 0.2% on the day, so a fresh record high here, but fractional gains to be sure. The S&P unchanged on the day. Most of the action, you're going to find that in big tech, particularly when it comes to chips. A record day for NVIDIA and Micron, which fell during the cash session, now moving higher in the after-hours trade. This is Bloomberg. All right, time now for the top three, where we name drop some of the people driving some of the day's most talked about stories. And we start off with who else? Zohran Mamdani, the 33-year-old poised to become potentially the Democratic nominee for mayor of New York City. This after Andrew Cuomo, the former governor of New York, conceded in that mayoral election. Of course, the results still need to be tallied for the Democratic primary, and the general election is still a few months away. We should note that founder of Bloomberg LP, Michael Bloomberg, endorsed and did contribute to the Cuomo campaign. Next up, Jeff Bezos, the Amazon founder, set to get married in just a few days. Celebrities already pouring into Venice, Italy for the big nuptials there, including the likes of Ivanka Trump, her husband, and as well as Diane von Furstenberg. And third up, we want to take a look at Cooper Flagg, the Duke basketball star, expected to be the first name called later today in the National Basketball Association's draft, which tips off in just a few hours here. Of course, he has been one of the most talked about prospects in quite some time. We should note that this is going to be the first draft for the NBA following a college basketball season in which athletes were able to get paid by schools directly for their name, image, and likenesses. We're joined right now by somebody who tracks this very closely. His name is Adam Breneman. He is the co-founder of the College Sports Company. He's also the host of Next Up with Adam Breneman, where he gets to talk with a lot of folks in the world of college football and in the world of the business of sports. Adam, great to meet you here. Great to have you here on the program. I do want to start off with the draft tonight, and not so much who's there, but some of the folks who aren't there. We've talked a lot on this program about a lot of college athletes who, if they're not going to go basically in the first 10, 20 names in that draft, that economically, some of them actually might have better prospects in staying in college. And that's all because they're finally, after decades, able to make money off of their name, image, and likeness, something that you have helped facilitate.
Yeah, Romain, appreciate having me on. You know, it's funny, you hear about all the negative parts of NIL and athletes getting paid in college, but one of the real positives is it's really enhanced the college game, from college football, college basketball, because as you said, you have these players staying in school for a year or two more than they would have before. You know, it used to make no sense for a player to stay in school if they were going to be a third, fourth, fifth round NFL draft pick, a second, third round NBA pick. But now, with the money some of these players are making in their senior year of college and from NIL, from now revenue sharing, which is coming to college sports in 2025, 2026, players are making, you know, millions of dollars before they even play at the professional level. So you're seeing, you know, a better version of college sports because you have more talent actually staying in school for a few more years. And that's not going to stop anytime soon.
Absolutely. And even in the NBA, we talk about if you're not in the first round, you're probably getting a contract of less than $3 million. And you have some college players who are actually able to make more than that. I am curious, Adam, how those players make that money. Is it just about what they do on the field, how they perform on the field, or is it more about what they can do off the field and the way that they engage with folks, whether it's online or offline?
Yeah, in NIL with college sports, name, image, and likeness, you really have two types of it. You have NIL, which is really pay for play, where schools or their NIL collectives are paying players directly for performance on the field. Now, the NCAA has tried to hide that and not call it pay for play, but that's what it is. You have salaries that players are making in college from a group of donors from NIL collectives to play their sport. Then you also have what's really true commercial NIL, where you have what NIL was intended to be, the true partnership, where you have the local car dealership who sponsors a guy like Cooper Flagg, or you have a food or beverage company sponsor a star quarterback. That's true NIL. Players make money in both ways. Obviously, the better you are as a player, the more money you're going to make from the pay for play salaries these players are getting paid from their school or from the NIL collective. And then, as you know, the more of a following you have off the field, the more you know, it doesn't always translate from how good you are as an athlete to what your value is off the field. How much can you actually drive consumer behavior with your social media content, with your brand recognition and name? Those two aren't always correlated. So we see a lot of athletes in college who have big followings that may not be star athletes on the field, but they're certainly stars off the field on social media and get some big NIL deals.
What do the consumers of that content, what do they want to see from these athletes on these posts? Do they want to see their training, highlights, or are they maybe just behind the scenes in their house or wherever they're living?
It's behind the scenes content. It's the access that fans want. It's really the new age of athlete driven media. It's fans want to hear directly from the athletes themselves. It's why we've seen so many successful current and former athletes get into media and become social media creators, because if a big game just happened, Romain, and the fans want to hear what really happened, do they want to listen to the beat reporter break down what happened, or do they want to hear directly from the player themselves, from the players in the locker room, from a former player who just got done playing, break down the game? That's what fans really want to hear. And these athletes in college, I tell all the time, the more they focus on building their brand, building their following while they're still playing, the more successful they'll be throughout their career and making money off the field, and also after their career ends. You know, I tell guys, it's a lot easier to get followers and to be interesting when you're currently playing. You know, when I hung up my cleats, stopped playing football, it's a little bit harder to get people to take your phone calls and get followers than it was when you were actually playing. So there's no better time than when players are actively in their college careers to start building that brand.
So as those players, so let's say those players who transition from college into the pros, and they've sort of made that sort of commitment to the social media presence and engaging with the fans, if you will. Do you envision that as we get deeper into this and we start talking about folks retiring after 10, 15, 20 years, is that going to be a net positive to their post-professional career?
Without a doubt. Without a doubt. You see these players that leave their playing careers with massive followings, with brand recognition, with name recognition. They're just more valuable for the rest of their life. And as I said, it's way easier to build a following when you are currently playing the sport that then translate for the rest of their life. And you think about what so many players want to do nowadays. I mean, one of the most common career paths for former players is media, is hosting a podcast, is being on live television, is calling games in the booth, basketball, football, whatever it is. So many players want to be in that realm, in that area. And with all the opportunities now, you see so many guys who leave the sport with new opportunities and a following and leverage in that next phase of their life. You know, it's a transition that players struggle with. What do they do next? What do you do in the next phase of your career? But now athletes more than ever have an opportunity to build that following, you know, through brand deals, through NIL while they're currently playing. When I was playing in college, you weren't able to do that kind of stuff. You were not able to do a deal with the local car dealership. You were not able to sign autographs and get paid or do brand partnerships with Instagram and TikTok and X or Twitter. You couldn't do it, but now the players actually can, and I think they all should be taking big advantage of it.
Adam, great conversation here, and you're doing pretty well for yourself post-sports career. Adam Breneman is the co-founder of the College Sports Company. And speaking of those athletes who have found a new life post their professional career, our next guest has done that in a pretty big way. Myron Rolle is a former NFL player drafted back in 2010, and he made a pretty big pivot in his career to becoming a pediatric neurosurgeon. He's now a fellow at Johns Hopkins All Children's Hospital, and now he's adding the word host to his resume as it debuts a new show called Health is Wealth. Pleased to say that Dr. Myron Rolle joins us right now. And Myron, we talk about with Adam this idea of players and players, you know, who have left their sports careers, connecting with the fans, and more importantly, connecting with them directly. I am curious about your show, which is on Players TV, a network that was specifically created to sort of speak directly to the fans. And you have a show called Health is Wealth. You have some great interviews. We saw Cheryl Swoops on the screen there, and I think Ken Griffey Sr. as well. You also had a chance to talk to. What made you want to do this?
Well, thanks for having me. And I think what Adam said was perfectly correct. The athlete-driven content is so important. You know, I realized that being an athlete in my former life as a football player, we have an impact and an influence on the community. We can shift ways, we can influence individuals, especially young people, into doing certain things. I remember when I was young, I would try to emulate Deion Sanders, the way he stood on the football field. I would try to emulate Barry Sanders, the way he ran the football. And so knowing the kind of cultural and social capital that athletes have, transferring that and bridging that into the health community and that health discussion, now being a pediatric brain surgeon, as you said, this Health is Wealth show really does kind of illuminate that interface between sports and health, and allowing these athletes to be transparent and vulnerable with their own health journeys, and educating, informing, and inspiring our audience in doing that. So we're fired up about it.
The conversation you had with Ken Griffey Sr. was very personal for me as I went through my own battle. And just to hear him talk about how long it took for him to even be diagnosed properly. There's been a lot of discussions about when to get tested, whether the medical community is actually up to speed and making sure that they're guiding patients to the proper testing and the proper care once those test results come in. What was that conversation like?
It was a great conversation. Ken Griffey Sr. was incredibly open and honest, transparent with me. You know, he's somebody who I've looked up to for a long time. But hearing his challenges, even as someone who has the access to medical resources and medical expertise, struggle with sort of getting the diagnosis and moving along in his pathway. If it's happening for him, it can happen for any person out there. And so the fact that he was able to work through that and have his family around to help support that journey, it's important. You know, evidence and academic literature says we should be screening at a certain time. We should be looking for certain things, especially if you fall within a certain demographic, disease, condition, symptomatology, all these sorts of things. And if we're aware and astute to that, and we prioritize our health, just like we prioritize the food we're going to eat in the morning, or whether we're going to work out or travel or go to work, whatever the case may be, if we sort of prioritize and optimize our health, we can live a long time and continue to have an impact in this world. And that's what Ken Griffey Sr. and the other guests I've interviewed have done.
I am curious as to what advice you would give for, new folks coming into professional sports. We have the NBA draft tonight, about keeping an eye on their health. Obviously, professional sports is absolutely brutal. You make a lot of money in return, but it is brutal. And I'm curious what advice you would give those folks in making sure that once they get into their 30s, 40s, and beyond, they can live a healthy physical life.
Well, the first thing I would say is don't think that you're invincible, right? You know, conditions and disease, they affect all sorts of people. You know, genetic mutations can happen at any time. You can have damaged DNA that doesn't get repaired and then cancer starts or something like that. You can have osteoporosis. You have family history that can align or sort of cause your health to be in a deleterious trajectory. So there's a lot of different factors that can go into your health being in jeopardy. And so understanding, listening to your body, taking some time to understand your body, accessing those primary care physicians who are experts in this field, accessing literature, making sure that you're consuming the right things and you're getting the necessary sleep as well. Sort of those wins that you can do. Those are very helpful for you going forward. And as an athlete, you know, when you've been on top of your game, you want to live on time and continue to have value. And I think it's important that we prioritize now.
All right, well said, Myron, and I really encourage everyone to check out that first episode of Health is Wealth with Dr. Myron Rolle, a former NFL player and now a pediatric neurosurgeon fellow at Johns Hopkins All Children's Hospital. Stick with us. This is Bloomberg. Here's what the markets are going to have their eyes on over the next 24-hour earnings. Walgreens, Boots Alliance, and McCormick set to report earnings before the bell tomorrow. Nike coming in after the bell. We're also going to get some economic data, including those revised numbers for U.S. gross domestic product, durable goods, initial jobless claims also on tap, and a lot of Fed speak. Barkin, Hammock, Barr, Kashkari, all scheduled to speak. And we're going to have a special interview with San Francisco Fed President Mary Daly. That's at 8:45 a.m. Eastern Time, right here on Bloomberg.